So when we talk about management decision making, managerial decision making has 5 basic steps. Step 1, we're going to define the decision. Step 2, we're going to identify our alternatives. Step 3, we are going to collect relevant information so that we can evaluate those alternatives. Step 4, we're going to select the course of action that we think is going to be most advantageous. And step 5, we are going to analyze and assess the decisions made. So that's something that we'll look at after the fact to see if, did this decision work out the way that we had anticipated, and that will, that'll give us some insight moving forward if we encounter a similar situation again. Okay, so relevant cost and benefits are a key element of management decision making. We have to be able to distinguish between relevant and irrelevant cost and benefits. So relevant cost and benefits have to be considered when we're making the decision, but irrelevant cost and benefits have to be ignored. In fact, if we try to incorporate those in, sometimes we can reach an incorrect decision. Relevant costs and benefits are future-oriented, tied to cash flows, and focus on incremental effects across alternative decisions. So those incremental or differential effects are important to identify so that we can make good, well-informed decisions, okay? So incremental revenues, these are additional revenues generated by selecting a certain decision, a certain course of action, or a certain option, okay? Incremental cost or differential cost are the additional costs that we incur to pursue that same choice or course of action. And then incremental income is the difference between the incremental revenues and the incremental cost, okay? Now, the general rule that we're going to follow is that we want to make the decision or choose the alternative that is going to maximize income. Now, as we'll kind of touch on as we go, there are going to be non-financial or qualitative factors that management needs to take into consideration sometimes. But for our purposes, that's a little outside the scope of what we're doing. So for our purposes, we are going to focus just on the financial element, which is typically the element that drives the decision making in most cases. So that's what we're going to focus on, is the financial element. So from a financial perspective, we want to select the choice that is going to maximize income. All right, so when we are looking at relevant and irrelevant cost, all right, we've got to be able to categorize and identify types of cost, okay? One type of cost that is irrelevant is a sunk cost. Sunk costs arise from a past decision, and they cannot be avoided or changed. For that reason, they are irrelevant to future decision making, okay? So as an example, if we paid $1,000 for a smartphone, okay, that is a sunk cost, and it's not relevant to a decision to replace it if it breaks, okay? Similarly, depreciation on the original cost of an asset is a sunk cost. It's not going to change if we decide to replace that asset, okay? Most of a company's allocated cost, including fixed overhead, are going to be sunk costs. So it's important to remember that sunk costs are irrelevant, okay? Out-of-pocket costs require a future outlay of cash, and they are relevant for decision making. For instance, the cost of a future phone purchase is relevant when you're deciding whether or not to replace a phone. Now, opportunity cost is very interesting, okay? Opportunity cost refers to the potential benefit lost by taking a specific course of action. Basically, opportunity cost is what you're giving up. Okay, it's what you're giving up in order to take one action over another. Avoidable cost is a cost that can be eliminated by choosing one alternative versus another. Avoidable costs are relevant. Okay, so now what we're going to do is we are going to walk through a variety of different types of decisions, and we are going to look at some examples of how we might help management to walk through these types of decisions and to make the right choice here. Okay. So the first thing that we're going to look at is a make or buy analysis. Sometimes this is also called make versus buy, or it's called an outsourcing decision. Okay. So the company is deciding, do they make this particular item or component, or do they purchase it from someone else? So in this case, we are looking at a company called Fast Track. They are an exercise supplement and equipment manufacturer, and currently they are operating at 80% capacity. All right. So they're trying to make a decision based on this. Now, let me say this. When we're looking at make versus buy decisions, capacity is very, very important. It's very significant that this company is only running at 80% capacity. Now, why? Because if they were running at 100% capacity already, then in order to make this new product or component, they may actually have to expand their manufacturing operations, which would add to their cost, okay? But in this case, they're only running at 80% capacity, which tells us we have some extra resources available if we decide that that's how we want to use them, okay? So let's look at this example. They currently buy a key part for their main product for $1.20 per unit. All right, with their excess capacity that we just talked about, making this part would incur per unit variable cost of 35 cents for direct materials and 50 cents for direct labor. So the unit cost of the part's going to include direct material, direct labor, and factory overhead. All right. So management must consider the incremental overhead costs, which include power for operating the machines, any extra supplies they might need to buy, any additional maintenance cost, anything like that. All right, so management estimates that this incremental overhead is going to be about 20 cents per unit. Okay. So when we compare our cost to make this product versus buy this product, looks like we can make it for $1.05, whereas we are buying it for $1.20. So assuming that we are, operating, below capacity and we have the ability to make this, it looks like it would be a good financial decision to do so. Okay. Now, again, that's a financial decision. All right. Realistically, the company's going to have to think about non-financial things too. They're going to have to think about product quality. Can we produce a product that is the same quality of what we can buy from this outside supplier? We're going to have to think about timeliness of delivery. We're going to have to think about suppliers. We're going to have to think about our employee morale and workload, how this could potentially affect them. And so those are the types of things that we have to consider that are qualitative. But for our purposes, we're going to say that we are going to make this product because that is what is most financially advantageous. Okay, so now we're going to look at a sell or process further decision. Okay, so this happens when a company has a product that they can either, sell at a certain point, or they can continue doing more to it, adding additional value, and then sell it for more. Okay, depending on what kind of features they add to it and that sort of thing. Okay. So similar to the last one, we're going to look at how do revenues change and how do costs change and how does that ultimately affect income. Okay, so if we sell the product as is, we're going to get $50,000 in revenue and no additional cost because we're not processing it further. Okay, The option is to process it further. If we process it further, then instead of selling it for $50,000, we can sell for $150,000, but we're going to incur an extra $80,000 in cost. Okay, so we look at what the effect would be on income. Okay, so $50,000 with no additional cost just gives you $50,000 in income. $150,000 in income less approximately $80,000 in cost gives us an extra $70,000 in income. So from a financial perspective, it appears that it would be most advantageous for us to process this good further, because that is what is going to maximize our incremental income. Okay. Now, we're going to look at a scrap or rework decision. Okay, so this is kind of a variation of the seller process further. Sometimes in the manufacturing process, we get some defective products, we get some products that maybe the machine messes up, an employee messes up, the products are just, we can't sell them the way that they are. So we have to decide, do we just, write them off as scrap, or do we attempt to rework them so that we can sell them, okay? So, in this decision, what we're looking at, now this is assuming that these items are already defective, okay? We just have to decide, what do we do with them? Do we scrap them or do we rework them, okay? So in this case, if we scrap them, let's say that we've got, some person, that's willing to give us $4,000 for the scraps. Maybe there's, metal or something valuable, that they can pull from the materials. And so they're willing to give us $4,000 just for the scrapped defective products. Okay. If we rework the products, we could sell them for $15,000, but we're going to put an additional $8,000 in to fix them. Okay. So we look at the difference that this would make to income. Right now, the scrapped goods are giving us $4,000 in income. If we rework them, we get $7,000 in income. From a financial perspective, it makes sense to rework these scraps so that we can get the additional $3,000 in income. Now, these, of course, are just a few examples. You'll find a lot more examples in the reading this week, but this is the same process that you're going to follow for pretty much all of the decisions. We want to focus on what are the relevant changes in revenue, what are the relevant changes in cost, how does that affect income, and then we want to make the choice that is going to maximize our income. So I hope that this short overview has been helpful to you, and if you encounter any questions this week, I'm always here to help.